Hello traders and welcome to ChrisFX. Today I will take you through an exceptional trading strategy which is using the unicorn model, which is a concept by ICT himself, the inner circle trader. I will leave the link to his channel in my description in case you want to learn this model from the source. But I will show you exactly how I am using this model and what this model is in general. So let's waste no more time and let's begin with our video. So guys, the unicorn model is actually a combination of a fair value gap with a breaker block. Now, some of you are already aware of what those concepts are, but some of you are new, and I have decided to be a little bit more analytical when it comes to those videos because some of you are new and you don't know what those concepts are. So, as I said, this model is a combination of a fair value gap and a breaker block. What is a fair value gap? First of all, a bearish fair value gap, for those of you who are new, is the gap that is left on a candlestick. You see the bearish fair value gap right here. From the wick of this candlestick until the wick of this candlestick right here, you see we have this gap. If I was to circle it, let's say it would be this gap right here. This part right here is absolutely untested. So this is the bearish fair value gap. Now, the bullish fair value gap, as you can see, it is the exact same thing, but when we have, let's say, a bullish movement, in order for you to be able to understand it, it does not matter if it is created by a bullish candlestick, another bullish candlestick and a bearish one, since in this occasion we would be looking, let's say, to buy. So this is the bullish fair value gap. You see the gap that is created between the wick of this candlestick and also the wick of this bullish candlestick. This gap is now the bullish fair value gap. Let's now go ahead and show what the breaker block is, and then we will show the unicorn model and how to use it. I'm gonna show you 3 examples which are precious because no one else is showing those examples as analytically as I'm doing in this free YouTube channel. So imagine the knowledge that I am giving you in the academy, guys. Let's go ahead now and open the bullish breaker and the bearish breaker. So let's start with the bearish breaker block. And the bearish breaker block, let me type it in. Bearish breaker block right here. The bearish breaker block, what you want to see actually, I will zoom in a little bit more, or I'm gonna increase this size. What you want to see for the bearish breaker block is a move towards the upside, a retracement. Let's say you have a high, you have a low, then a high which sweeps the liquidity of this previous high, and then you are making a low which is breaking below this low right here. So if I was to take now this thing and move it towards the right side, then you would be having this exact pattern, let's say, right here. In other words, I will delete this right now. In other words, here we had a low, we had a high, we had another low, then we swept liquidity above this high right here. As you can see, we broke below this low, at least right here, but also this low that created the move. And then this last bearish candlestick that you see before the up move that grabbed liquidity is your breaker block. It is your bearish breaker block in this occasion. Okay, now I'm gonna go ahead and show you the bullish breaker block. And then we're gonna be going ahead and combining everything together, which will give us the unicorn model. Let's go ahead and show the bullish breaker block in this occasion. As you can see, we had a high, okay, then we had a low which swept liquidity right here, and then we broke above this high, Now, this last up candlestick now, before this down move that swept liquidity, this last bullish candlestick, I shall say, before the low that grabbed liquidity, this is your bullish breaker block. And if I am now to place everything together, let's do it in order to make it easier for you to see. So, let's go ahead and do that. Let's go ahead and do that. This is your bearish breaker, the last down candlestick before the move that swept this liquidity right here. And this is your bullish breaker, the last up candlestick before the move that swept this liquidity right here. In order to remember it, remember that the bullish breaker is, let's say, created by a bullish candlestick or multiple bullish candlesticks. I'm going to explain what I mean, and the bearish by the last bearish candlesticks, if you are struggling to remember what this thing is. I will show you now 3 very precious examples, and in case that you have any questions, go ahead and type them down in the comment section. I will be answering every single one of them. And our examples, guys, are exactly right here. I will go ahead and delete this one. You can use several things to identify what is going on. I'm gonna show you an example where we are grabbing liquidity below hourly lows, okay, as we have, of course, entered, or as we are entering the London session. So here you will see from the hourly time frame that we have grabbed this liquidity below these lows, and the time is 3 a.m. New York time, which is London kill zone. Actually, this is the liquidity that has been grabbed, and all you have to do when you see the grab of liquidity is to scale down on the 5-minute time frame. It works on all time frames, it works on all currency pairs, it works on indices. So before you ask me, it works on all of those. What is now the unicorn model? As I said, it is a combination of a breaker block and a fair value gap. Here we see that we had a move, which is the same move that I showed you on the hourly, that broke below, grabbed liquidity, and then it broke above this high and changed character right here. So when you see this thing happening, of course we are inside a kill zone. Right here we are into the London, let's say, trading time zone. So this is more than enough. What you're going to see is a breaker block. Now my breaker, as I explained earlier on, is this last up candlestick before the down move. Now this is where it becomes a little bit tricky, guys. Okay, I have this breaker right here, which ideally, this is the unicorn model, it should be overlapping with a fair value gap. Okay, should be overlapping. Now in this occasion you see that the fair value gap that existed here, this has been tested already. So theoretically you would say that we don't have the unicorn model here. Here is where it becomes a bit tricky. Some people identify, including me many times, we are identifying the breaker such as the last, all of those last up candlesticks before this down move that swept liquidity. So this is also absolutely correct. You can do that because you want to see an overlapping, let's say, fair value gap with your breaker block. And yes, if you are strict enough, your breaker block could be this one, but it is not mistaken that all of this up move, all of those candlesticks are now your breaker block. So in this occasion you can say, within this area of this huge breaker, of this huge up move before the move that grabbed liquidity, do we have a fair value gap? Yes, we do. Right here, you see, we have a bullish fair value gap. Since we have such fair value gap within this whole area, so what I want to see, guys, in other words, I will go ahead and identify only the last up candlestick before the down move, but what I want to see if in this whole leg there is an untested fair value gap. This is how I'm trading this model. Probably it is not exactly as ICT is showing it, that's why I will leave the link to his channel down in the description, but this works absolutely fantastic. What you will be doing now, you will be taking your trade from the beginning of the breaker with a stop loss either below the breaker, which is the riskier, let's say, stop loss from the two, and the other stop loss could go all the way below this area. There are pros and cons on all of these concepts. Now if I go to the hourly time frame for targets, let's say we can target probably, no, this is very low, this swing high as the first one, or we can go even higher, guys. We can target swing highs such as this swing high all the way up here. Okay, so you can say I want to target this area all the way up here, or maybe I want to target this FUG. Now, ideally, I would like to increase my reward to risk, and I would risk it, and I would place my stop loss not right below the breaker, because there is the fair value gap, this fair value gap. Below it, you will tell me there is another one below it, but I can do something like that, increase it a little bit, and this suddenly becomes a 3.85 reward to risk. Let's see how this played out. There you go ahead and you do hit your final target. So again, there are various ways to identify your breaker block. I like to identify it as the last up candlestick before the down move that swept liquidity. Nonetheless, it is not mistaken to identify all of those candlesticks, all of those last bullish candlesticks, and say, if there is an overlapping fair value gap within this area of all of those candlesticks, then I have the model that I want to trade. At least this is how I'm trading it. If this exists, then it is fine if you only take the last candlestick in order for you to place the trade. Now we win this move right here, and if you would be very aggressive to place your stop loss right below this area, this would be even more, but if you do that, you will be losing many more times than you expect. Now I'm gonna show you an example right after this example, where we just sweep liquidity from the hourly time frame, which was also our target. Also, you can check it out from the 5 minute, it is absolutely fine. But let me go to the hourly to see if we have an overlapping area. We don't for the moment. Anyways, I scaled down to the 5, it is absolutely fine. You can identify it like that, and you can trade this model as well outside of the trading hours that you have been taught. It is absolutely fine. So what do I mean by that? You don't necessarily need to trade this model, let's say from 3 to 4 a.m. or from 10 to 11 a.m. New York time, or then from 2 to 3 p.m. New York time. You can trade it normally, let's say from 2 o'clock until 5 o'clock a.m. Then you can trade it starting from 7:30 or whatever until later on, until 11 or 1 o'clock. It is fine. So I will not get into the time zones and all of that stuff, because this is not the point of this video. Okay, so now guys, already I see after this sweep of liquidity of these highs right here, I have an additional sweep of liquidity exactly right here, and now I have an additional one right here, and it is 6 o'clock. Okay, now we don't have, okay, there you go. Now you will see that this is a different example than the one that you are used to. My point here is to show you how I'm trading it, and not exactly as, for example, it would be supposed for you to have after this grab of liquidity. It would be better to see this one getting now broken, and then go ahead and identify your bearish breaker block, which would be this one, in order to place your trade. Nonetheless, you have to understand that you have to be adapting to the markets. So after this sweep of liquidity and after this one on the 5 minute time frame, how I am trading it, let me go ahead. Okay, you will tell me, Chris, now your breaker is down here supposedly, because this is the lowest point from the point where we grabbed the highest liquidity. So here we didn't grab the liquidity above this area. So technically this one is not the model that we want to see. Nonetheless, I would go ahead and say it doesn't matter. We had this grab from the hourly time frame. If I go down, we had a grab of liquidity right here. On the 5 minute, we grabbed even more liquidity. We retested this order block, which is this week. I'm adjusting to the markets, guys. It is not just one thing that I'm trading. And if you want to learn way more things about bias analysis and all of that stuff, join the academy instantly, or the trading signals and the mentoring, of course. It is dope. So here I would go ahead and I would say, even though this is the highest point and technically this is the breaker block that we are talking about, I would adjust it since we have those multiple breaks of structures, and I would say now my breaker block is this one. Okay, you can go ahead and identify all of the last bearish candlesticks in order for you to say, do I have an overlapping fair value gap? So a fair value gap which falls inside this area. And in this occasion, you can even say that if I identify this breaker right here, because this was the last bearish candlestick before the move that swept the highest liquidity, you can say that if I have from this breaker right here, a fair value gap that overlaps. This is a little bit different than the unicorn, this example right here, but I wanted to show you this example as well because I would go ahead and trade it. Again, I'm showing you those things and I'm dedicating my time, so do not go ahead and write me bad comments. I said it is probably being taught differently by ICT himself. That's why for those of you who don't know him, I'm pretty sure that all of you know him, but for those of you who don't know him, go ahead and learn the model from the source. This is my channel and I'm showing you how I'm trading it. I'm sharing my knowledge. So there you go. There is an overlapping FEG from this area right here. What you can do in this occasion, I would personally go ahead and I would adjust it to this one, to be honest, as I said, okay. And I would say that from this area right here, then there is an overlapping FEG, which is this FEG. So this is my discretion applied. Okay, in this example, the first example was a proper example, let's say, of a unicorn model. This is another variation, which is also very strong. You can use it. And here you can go ahead again and say that I'm going to place my entry here with the stop loss right above the area, or with a stop loss above those highs. If you choose a stop loss right above the area and the target, let's say, where would your target be? Either all the way down here or over here. Let's see how this would play out. You can choose a 5-minute area such as this area right here for a 5.8 to 1 RR. Okay, here you would be stopped out if you would have a tight stop loss with this one, so you see both examples. But if you would have the stop loss all the way up here, I think you would be pretty safe and you would be hitting your target. So you saw the first example that we showed, which is the proper unicorn model. Right here we had the stop loss right below the area and it worked out. Here with the stop loss right above the area you would be losing, but in both examples, even though this is not the proper unicorn, it is a variation that I like to trade. Again, if you would place your stop loss above those areas, you would be absolutely safe, guys. Now, I will show you yet another example. And this other example is all the way down here. What I will do, I will go to the daily time frame. So this example is going to be from the daily time frame, and we are already where we want to be. Let's delete those lines to make things clear. We are on the daily time frame right here, and let's suppose that we have this fair value gap created right here. And the remaining part of it, of course, is this part, which is absolutely untested. Okay, this is from the daily time frame. Again, you can scale down to the 5-minute instantly and say, I will be waiting for price to get back into my point of interest. And of course, I'm gonna be taking a trade if price gets back into my point of interest. Let's move forward. Okay, there you go. Let's extend those to the right. Okay, this is your fair value gap between those two lines. Now, if we were to see the unicorn model, we would like to see this high being taken. We don't have such thing. And later on, of course, no, this would be the one. Now we break below our fair value gap. Pay close attention though. Pay very close attention. Okay, another variation of the unicorn model. We are inside the daily fair value gap. What you see right here, guys, is a wick. This right here is a wick from the daily. It is still respecting this daily fair value gap. If a wick penetrates it and the body does not close below it, for me, we are still respecting this fair value gap, plus we have tapped on this order block as well. Okay, so here I would still be considering taking my trade. This is not an example which is the very easy example like that. Okay, you break above, you identify your breaker right here. There is also a fair value gap overlapping with this area and you take your trade. This is an example that you have to see because it is from the daily. Here, the grab of liquidity happened exactly right here. So if we are to break above a certain area, it would be this area and then with a body of the 5-minute, and then we would be looking for our unicorn model, guys. And here, since we broke with a body, you can go ahead and, as I said, highlight all of these up move, all of those candlesticks before the down move and say, do I have an overlapping fair value gap within this area? Yes, I do. I have this fair value gap right here. Furthermore, below this area, everything has been tested, at least on the 5-minute time frame. So what I can do, I can either place my pending order here, I can even place it a little bit lower, and the stop loss can go below the breaker, or if I want to be extremely safe, below this low right here. Let's see how this one plays out. There you go, perfect reaction. Okay, because we have from this area right here, we have this breaker block. Okay, and overlapping we have the blue zone, which is the FVG. Let's see how this plays out, guys. And for targets, I didn't talk about targets again. We can target points of liquidity such as this one or all the way up here. This will do it as well. And if I go probably to a higher time frame to check out if we would win this whole trade, you see that we would have won this trade as well. I just showed you now some variations, actually one variation. This you can absolutely use. This is the model as well, but I also showed you, if you saw this one right here, which is a variation, the proper and most easy to identify unicorn model would be this one right here. Again, let's explain this example right here, which is the proper unicorn model, and then go ahead and subscribe to my exceptional services to teach you more amazing things such as this one, and have a mentor who is taking his trades live that you have never had before, guys. So here we had this up move, then a down move which swept liquidity. This is a perfect example. It happens between, let's say, 3 and 4 o'clock, which is within the London time of the market. Here you go ahead and identify the whole all of those bullish candlesticks before the down move that grabbed liquidity, and those are those candlesticks, and you say, do I have an overlapping fair value gap? Now on the 5 minute, you can do it on any time frame, which is untested, okay, untested within this area between those two lines, which is the huge breaker, which is this one right here. And you say, yes, I have a fair value gap. It is from this candlestick to this candlestick right here. Since you have this, you can go ahead and say that now I'm okay to place my order from this last up candlestick before the down move. Or again, guys, you can take it from the top. It is absolutely fine. It is not a mistake. Okay. You can take it even here with a stop loss below those candlesticks right here and go ahead and hit your targets. It is the exact same thing. No problem at all. And you will tell me, what is the point of a fair value gap being created within the area of the breaker if we are not taking the trade from the fair value gap? The point is that this is a confirmation of your model. When you have those things together, the breaker block and the fair value gap overlapping within the area of the breaker block, then you are good to go. Then I showed you a variation, which is a variation because ideally we would like to see this being the move. After this sweep of liquidity right here, you would like to see this being the move that breaks, but as I said, you have to be adjusting to the markets. You would be missing this beautiful move right here. And then I showed you an example from the daily time frame, a daily tap on an FVG, a rejection of it, and this was the last up move before the down move that swept this liquidity. And we went ahead and identified the very same things. So hopefully you found this video helpful, guys, and if you want to be able to form a bias and combine this thing with way better strategies and with way more advanced strategies, go ahead and enroll in any of my exceptional trading services, because I'm going through so many things and I'm updating my academy again and again and again with new and powerful educational content. Go ahead furthermore, subscribe to the channel, to this channel and to my other channel, the SMC Trader. Leave me a like and a comment, and go ahead and check out the original video from ICT's channel, for which the channel I have left the link down in the description. This is gonna do it for today, traders, and thank you all for watching. Until next time.